what are the kind of typical challenges that early stage startups face in terms of accessing capital. Though I have my own views in terms of is capital the key reason that a lot of these businesses get held up, may not essentially be true. But having said that, a lot of people still, it's the reality that a lot of people still face challenges at various stages in terms of accessing funds and probably they're unable to move to the next stage. So I will not take much time. At the same time, we have, you can see our speakers here. Their introductions and at least a brief introduction is available. And if you're interested in looking up their profile, their profiles are available in the scanner. You can scan the QR code and you'll get access to everything. So I will not get into that because we have we want to make optimal use of their time. And so what I will do is we have based on the feedback that we have had over the last few months interacting with entrepreneurs is that there are a lot of questions around what are these angel funds? Do the angels really look like angels? So what kind of people are they? Do they, or are they? If you happen to let's say tap into the wrong angel, what happens to you? After some time. And the other thing is we have a lot of these social enterprises, right? If you see both sides of the room, we have these big charts available to demonstrate what kind of enterprises are mostly being run by women. So you see there are a lot of social enterprises. So social enterprises again they need funds even to start. So how do they really access? What kind of access can they even think of? How do they really access? So there are interesting things that we will learn today. And the other thing is something called strategic capital. Strategic capital is again very interesting. A lot of these businesses would need it, particularly people who are real innovators maybe, or people where the gestation timing is a little longer. They probably need to kind of store some amount of energy in the form of capital for themselves. So that's strategic capital. We try and understand what it is and why some of these enterprises or businesses will be making it. So with that, I will start. So my first question, let's start with Angel because Angel was expected to be very nice people. So I have next to me one Angel. She has volunteered to talk about Angel Network and Angel Funding and what do they do, how do we access them. And she comes from Saima comes from Bangladesh and she is running this venture for quite a long period, so she has extensive experience in that. With that, I would request Saima to share her experience of working in this domain and how should people go about accessing angel fund. What is that an angel fund look like, and what do they really do? What can you expect from them, and what do they expect from you in turn? And how do you really negotiate those terms and trade? So, if there is anything like that you need to learn. So, with that, I request Saima to finish.
Thank you for the fantastic introduction, and thank you to Grace and also the US General Consular to invite me. So, really privileged to have met all these wonderful women. I was sitting on the table and I was trying to network with as many people as I could. Catch up with all of you in next 2 days. So, just to give you a brief, what is an angel investor? Who is an angel investor? So, here we angel. Because when nobody believes in you, we believe in you. So, when you come up with an idea, when you have nothing solid, you don't have any traction in the market, you haven't earned much revenue. So we are the first investors to believe in your idea, to believe in you as a person, and to fund your startup. So we usually fund a startup when it's in its pre-seed or seed early stage, because at this stage you don't need a lot of funds and you don't have a lot of fun. So we give you a small fund to start off the business. If you have an idea, you have a prototype, you have an MVP, but you need to build a technology. And in exchange, we ask for a small equity. We take up a small equity, and also we handhold the founder 12 or 13. So that's also another reason we are called Angel, because nobody else would be advising you on a monthly or regular basis in your business. Because we have an interest, to invest in the business. That's why we not only invest in terms of financial or money, but also we try to give you as much mentorship as possible. So that's why my request would be, when you're looking for an angel investor, look for somebody who has a passion and interest and knowledge in the field that you're building your business in. If you're building your business in fintech, then look for an angel who has worked in fintech for quite some time, and that person can actually guide you on where to go next, or who to go next for your next fundraise, or how to develop your business model, or how to get connected with partners. So these people will be helping you to go and bring your business to the next phase. And that's why we're called angels. So,
Yeah, and that makes sense.
and just to give you a small background on Bangladesh, so Bangladesh is 170 million people country. We are the 8th largest populated country in the world. The whole startup journey actually started probably from 2012-14. So we're still new when it comes to startup, to be honest. When I graduated a long time back, 2008. So when we were graduating from university, all we wanted to do is to look for a good corporate job. And now when I talk to the young students, when they graduate, they have already built the idea, and they already have a small initiative. They already have invested in a small project. So I really see this entrepreneurial, mindset both in India, Bangladesh. Also, I spoke to some Nepalese entrepreneurs, and this shift in mindset is happening throughout South Asia, and this is fantastic.
Thank you.
Another thing why startups is booming in this sector is because when we got independent in 1971, we were one of the poorest countries in Asia. If you look at our economy now, we have a 460 billion GDP. We're growing at an annual rate of 7%. We have achieved the status of a least middle income country in 2015, and on the way to become a high middle income country very soon. So we have come a long way. Our median age right now, it's a very young populated country, is 28. So very young population, across the country, we're adopting technology really fast. The internet penetration is growing really fast. We have around 50% internet penetration. The phone penetration, mobile phone access is around 95%. So people are becoming tech savvy, and they're learning more about technology. And this shift in our demographics has encouraged a lot of startups, people to build their own businesses and to build technological initiatives. So that has given us a fantastic growth. And I'm here today to learn not only about Bangladesh, because we really want to collaborate with markets like India, which has done fantastic in startup world, and we have so much to learn from India. So we really look forward to India.
But we look forward to Angel from Bangladesh. Okay. All right. So thank you. Now I would request let's go over from Angel to social enterprise, because let's kind of keep jumping from one to another so that we don't get bored. With that, Snigdha, if you can quickly take us through the, let's say the landscape of funding available to social enterprises, and what kind of business models, because business model is where, or the revenue model is where they typically get kind of put down. So how do they can really innovate around that to access some of these funds? We can kind of quickly take us through that.
Sure. Firstly, thank you for the opportunity, and lovely hearing your thoughts. And so nice to hear about Bangladesh. I represent an organization called Social Venture Partners, and our work is basically to encourage philanthropy in the cities that we operate in. It's a global organization with 8 chapters in India. And, the purpose of an SPP chapter is to really support the social ecosystem of that city. And how we do it is, imagine a Venn diagram. There is a not-for-profit sector, there is a social enterprise sector, and in the middle of them is this word that we use that's called the hybrid, model. So the social enterprise sector, as many of you are aware, you yourself are social entrepreneurs, would know that this is where you kind of are doing something where you are also creating, some social impact. You're running a business which has an impact on the communities that you serve, your customers, the people who are actually working for you are the ones who are maybe marginalized, vulnerable, and you're trying to create a business model out of it. The not-for-profit, on the other hand, is one where there is no real business model. It's what we technically refer to as the consumption model. So a not-for-profit has to survive purely on fundraise, right? Very gone are the days where organizations would have created a corpus and they're all able to probably survive out of the returns generated from that corpus. So what I wanted to stress on today is that little piece that we call the hybrid sector, right? In my experience now of running SPP in Kolkata for 6 years, whenever we have a discussion with an NGO partner on sustainability, the first issue that comes up is where is the revenue model really to stay, right? When you're a not-for-profit, the government has a lot of these loopholes, a lot of legal clauses that you can't earn more than 20% of your annual turnover.
Sorry,
The revenue can only be up to 20%. How do you build sustainability in such a case? That means you have to stretch your to sustain 100 rupee worth of expense. So when we got deeper into some of the work that our not-for-profits are doing, we understood that many of them have a very, very strong model of supporting, the underserved and the vulnerable community, and they are creating products. They also have technical service models. So how do you really utilize this capability so that these communities can be served year on year and they're creating something that can catalyze further growth and scale, right? So I'll just take one example of an organization called Kadam, which is very much, headquartered in Kolkata, makes the most amazing handcrafted baskets, and they train rural women artisans to make this. So maybe different products are also exporting to the US. When their founder came to us about 5 years back, he said that can SPP fund us for creating our own website with COVID coming in and with the offline model of selling in exhibitions, causing a lot of delays in working capital, cash flows for them. She said, I see that online marketing is a place for us to do. So we said definitely go online, but how are you going to sustain the fact that you now have 2,000 women artisans who are working with you, and that paycheck of 6,000 or 7,000 rupees has to reach them every month? So they said we will empower them, they can create marketing communities among themselves, they can sell these baskets. But when we went to the communities, they said we only know how to make the product, we don't know how to sell. This whole online is all coming down to us, we don't understand it. That's when we said that let us empower you by helping you create a hybrid model. You create a for-profit entity which is actually going to be your marketing arm. And that marketing arm, the profit that it generates, a part of it can also be divested into creating further scale, and definitely the revenue is going to sustain, what you are doing in terms of helping these rural artisans. So when I was talking to Sandeep this morning, what happens is this area is still not evolved so much in India, but on the global platform there are these fellowship programs like Because, the Change Makers, which Mastercard supports. It's all talking about sustainability, right? Unless you build an organization that can in 4 or 5 years become sustainable. For that period of time, as a social entrepreneur, by all means you need to go out and ask for help. You need to increase that lux surface area where you keep banging on people's doors and saying that here is my proposition, this is what I'm going to do, and this is how I'm going to change the world, this is my effort towards it. So please support me for the first few years. a lot of the innovation, research, a lot of the capacity building can actually be where you can raise funds from your not-for-profit, and selling the revenue of or the service is what you need to focus on at the for-profit side. And then you have a very clear arm's length transaction, so your donors are aware how you're dealing with both these organizations, very transparent financial accounts, and you make the pitch based on the donor. So for example, if Kadam got an organization who was wanting to treat them as a vendor and not as a charitable cause, they would need a GST number for them to give them an order of 6,000 baskets. Now if Kadam went and said that I don't have a GST number, I'm only registered as a not-for-profit, they would not get that order. Whereas if you show them that you have the ability to handle both of these simultaneously, so someone, the World Bank funds them for training these groups of women. A vendor or a corporate may not want them, a customer may not want to do that. So both these have to work simultaneously.
Great. So that does that mean for the hybrid part? So let's say if I need this community to be, let's say, let's say the capacity has to be built to the next level. Obviously, I can't spend the for-profit money in that. So this is why probably I try and get the not-for-profit and bring them up to speed. And once they're ready to work at a certain skill, whatever they make, I then pass it through the for-profit route so that I can take advantage of it.
Absolutely, and that's what people like us exist for.
Okay.
I mean, our work at Social Venture Partners is what the angel or the VC space is to for-profit for the whole social sector.
Okay.
So, we are ready to fund that capacity building. We are ready to fund those pilots.
And in terms of statutory compliances, so the transactions between these two, transaction between these two, so they are reasonably manageable, right?
Reasonably manageable. Like I said, the space is still evolving. There are some experts who have now gone deep into studying these models. There's a very successful organization in Pune called Under the Mango Tree, which is into bee farming, honey farming. So they farm bees and they created these FPOs for farmers who are into producing honey. Very, very successful example of the hybrid model. There's another one called Recharkha, which is using this multi-layer packaging that comes out of biscuit and chips packets and transforming them into these beautiful bags, weaving them. So all of these, because the products are so amazing and they have a worldwide market, they've realized that going hybrid is the only way to sustain it.
Thank you. Alright, now I come to Sushma. Sushma, please help us understand this. Let's say this. How do you really go about identifying a VC? And the VCs will obviously expect certain things from you. So, what level of maturity do they expect, and how do you really prepare yourself? And then, let's say in a situation where you are alone, one particular person running the whole show, vis-a-vis maybe co-founders. So, if you can just help us understand that scenario a little bit.
Sure. First, thanks so much for having me here today. And it's wonderful to meet so many very inspiring founders, all of them building wonderful things. But I've been chatting with a few of you, and I gathered that there's a lot of interest in what VCs do thanks to the Shark Tank format, right? And for many founders, I have realized that it's almost become like the end goal, right? If you are able to get a VC, you have arrived in life, not knowing what it entails, right? So firstly, for all of you who are building wonderful businesses out there, not all businesses are VC investable businesses, and hence please dispense that myth that VC fundraising should be your only go-to strategy. It is not. There are many ways to build solid, strong businesses while keeping your mental health in place, right? So that I want to dispense that myth up front, because there seems to be a lot of glamour associated with VC, and as you rightly said, everyone is giving out cards, claiming to be VCs and wanting to do all the cool things, but it is not everyone's cup of tea to take that money. Second, like Saima mentioned, there are angel investors. VCs typically come into businesses where they see growth, right? And they see significant growth, because that's the business model of a VC. You invest in about 30 odd companies. There's a high degree of mortality, but there should be 2 or 3 that will hit the ball out of the park and give them outsized returns. And that is what makes the VC model a lucrative model. So if your business is a good, solid, slow growth, profitable business, it's not necessary that all VCs will like it. And hence, if you go to 10 VCs and you hear 10 no's, that doesn't mean your business is bad. It only means that it doesn't fit the VC model. So that is something I would like to tell all the entrepreneurs out there, especially the women. Don't take it personally. It has nothing to do with your model, nothing to do with who you are. It is just not a VC investable business. So that is something I would like to clarify on the VC side. Now coming to, because many of you are social entrepreneurs, even in the VC space, there are different types of investors. So the color of money is slightly graded. There are impact VCs, and there are commercial VCs, and there are some in between. And what differentiates the VCs are their risk, return, and impact profiles. So on a 3x3 matrix, you can put all these VCs in different blocks and see who fits in where. Impact VC, actually I've spent close to 19 years of my life on the impact side, first with Ashoka and then with Avishkar Capital, which was one of the largest impact VCs in India, before starting off 108 Capital, which I see is the impact version 3.0 in India, trying to back passionate founders who are building on digital India stack. So that's a very VC investable type of business. But coming to the impact investors want to see who is doing strong grassroots level work where you're really impacting society, people, planet positively, and while creating sustainable models. So one great playbook that has worked beautifully in the impact space is microfinance. Right now, some of you might argue that that's not impact, but unfortunately, that is the poster child for impact investing, because they have demonstrated that this is high on impact, largely focusing on women beneficiaries. They claim they bring women out of poverty. We can debate that. They've demonstrated that these are sustainable models. They grow year on year. They have demonstrated that they have the ability to generate cash profits. They've also demonstrated that they can go and list themselves publicly, which means that there is a wider interest in models like this. Now, that's checking off everything that a VC investor would like to see. However, beyond microfinance, we need to see which are the other models that lend themselves well. So we identify sectors like handicrafts, artisanal businesses, which have the ability to scale. One such example investment was in a company called Jaipur, Fab India, fantastic company from an impact perspective, working with artisans, and a solid business model. So those are the kind of impactful businesses that we see. The non-impact VCs, I think we've all heard, right? Like there's a Swiggy, there's a Zomato, there's a Flipkart. I don't think we need to discuss those models. Those are very different. But I thought it's more relevant to talk about healthcare. It's a big problem. When I say version 3.0 of impact, about 15 years ago, one of the biggest challenges we were facing in India was access to finance, access to healthcare, access to education. Thanks to the entire digital intervention, with India growing digitally, 50% penetration, both digital penetration, mobile penetration, internet penetration. Someone mentioned that in Bangladesh there is a gender divide when it comes to digital adoption, but in India we are seeing it's 50-50. That means both men and women are consuming digital information almost equally. It's a different matter that they might not have their own devices yet, but once they do, they are pretty savvy to use all of this going forward. So I think with that we have solved for the access problem. Now it is building the right products at the right price to get it to the right customer base. So that is the whole new India story. So 10 years later, if we are going to be talking, I think we will be seeing a whole different type of social enterprises emerging from India, solving for the big problem statements that we have here.
Thank you. Thank you. Now, Yamika will come and I'll actually pose a little different question for you. But if you don't want to answer, you can refuse it. But let's say in the VCs, she rightly pointed out that people would be expecting that multiple X returns, right? So when you are looking at multiple X returns and you are reviewing the business model, do they really look at both growth potential as well as profitability potential, or what is okay to be compromised? If you can help us understand that part a little better.
I may have to refuse to answer that question, but I'll maybe answer it in my way. So hello everyone, absolute pleasure to be here. I was mentioning it to some people earlier that whenever I am in a room full of females, the energy just hits differently. So thank you for having me and wonderful to be amongst all of you. So a small introduction about me and then I'll get into maybe a little bit of explanation of what I do at the organization that I am and then come to this question. So I am Yamika and I'm a partner at FaveC Venture Builders. Now a venture builder is an organization that comes before even an angel. So when Simon was speaking, I thought I'll take the mic and tell people that there is a partner in the ecosystem that comes ahead of angel as well. So venture builders are entities or organizations that work with idea stage founders, idea stage startups. In fact, I want to educate people in this room that if you have access to aspiring founders, people who want to get started but don't know where to start, how to validate their idea before they start, a venture builder would be the right partner for them. So we start, like I said, working with startups at an idea stage, validate the idea, validate the market for them, and then we build strategy with them, and then we give them resources for product development, for growth, for marketing, for branding. We give them resources and co-build the venture with them. And of course, bring capital as well onto the table, access to capital onto the table. So with FaveC, we validate ideas, strategize with ideas, we co-build with them, and via our own angel network, we also bring capital onto the table to help them build a 0 to 1 journey. 0 being idea, 1 being MVP, minimum viable product, and early traction stage. So 0 to 1 is something that a venture builder helps. And when we also need to, when I say validate, we validate the idea from a market potential and market feasibility point of view, which means that how big is the market for that particular idea, because at the end of the day, any organization which is for profit, whether it is a VC or it is a BB, everybody wants to work in spaces that are scalable, exponentially scalable, and profit can be made out of them. So that's for us as well. We look at the size of the market, what we call TAM, the total addressable market. It should be large enough. And we look at the untaken positioning in the market, whether there is a white space in the market that can be taken up by that idea. Because if it is untaken, then you can build it up even with frugal capital. So that's the catch. So we look at that. And then on the business model side, for us, we look at ideas, right? Where there is no product, there is no traction. So we can't look at month-on-month growth numbers and take a call of how well the venture is doing. So what we look at instead is something called the unit economics or the LTV CAC model. Very simply put, LTV is lifetime value. The total amount of revenue that a customer can bring to you in his or her entire lifetime versus the acquisition cost of the customer. How much are you spending to acquire a customer, and then how much are they giving you in their lifetime with you? So a ratio of that gives you very beautifully a sense of how unit economic viable is that idea, is that revenue stream. So once we evaluate that, we're able to assess whether we should go ahead with this idea, with this revenue model or not. And that gives us a sense of whether this business idea makes business sense or not. So yes, I hope that addresses some
So
part of the
actually, I
question.
had a question for you anyway, looking at the kind of model that you're looking at. So how are you different than, let's say, an incubator or an accelerator? So, these are again some terminologies people kind of keep looking at. So are they different? If they're
Yes,
different,
it's
how are they?
very definitely different. Like I said, the venture builder would come ahead in the journey of a startup. Before that, I actually have a slide on that, but I'll maybe give a understanding of it in gist. So, an incubator or an accelerator would take you in as if you're a startup. Once you have some semblance of a product, some semblance of traction, that's when you go to an incubator, you go to an accelerator, and they can give you mentorship, they can give you connects, they can give you some capital, they can give you access to some projects, open some doors for you, etc., etc. But you need to have started off. And of course, we know angels obviously are able to help you, sometimes maybe at an idea stage as well, but more often you have to have reached at least the minimum viable product stage for any entity in the ecosystem to be of help to you. And of course, we heard Sushma speak that when are you ready for VC? I mean, of course, once you've achieved some amount of traction, some amount of revenue growth, etc., that's when you're ready for that. But a venture builder starts working with you at an idea stage. So, when the idea is in your head stage and you don't know whether you should go ahead with it or not, whether it makes business sense or not to go ahead with it, that's when you go to a venture builder who comes in with strategy, resources, and capital to co-build the venture with you. So, yeah.
Thank you. So I have Premji also. She's an entrepreneur herself, and she's one of our discussing. So now I would go to her, and because
This is something which you spoke mostly about the equity part. Now you have an experience of probably working on both equity as well as debt. So you want to comment on, you would have probably bumped into many VCs, would have worked with many such people, and also the date part of it. So and you have probably multiple ventures in the last few years. So you just quickly take us through your journey on that.
Right, okay, so I guess sitting on the other side of the table, is the entire fundraising experience can be daunting, but it can also be, but not necessarily, because there are, I think that Sushma said that you can hear 10 no's, and you can, but it's not necessarily that your model is not right. It's just that it doesn't fit with the specific VC thesis. So this is something I took some time to learn, because I remember during my first fundraising journey, there were a lot of disappointments. I gave up only, but then again came back. Now in terms of debt versus equity, this is an interesting discussion that I had with my brother when we were starting one of my cousin brothers who also heads the finance at Tata Steel, that should we do debt or equity? He had kind of given us advice that debt is not a great idea at the start of your venture. At the stage of an idea, you might take a couple of years to get to traction, especially if it's a digital product. We know that for digital, if it's a lifestyle business, you will probably be profitable from month 1 or month 2. But when you're investing in a digital product, when you're investing in building something, there's a lot of R&D involved, there's a lot of build-up involved, there's a lot of production, engineering cost involved. So if you are then taking debt at that stage, you will have the pressure to repay it back. With debt comes the pressure of repaying interest. And we have been in that boat. We have taken huge debts, and we've also seen the fallout from that. So again, equity is the most expensive thing that an entrepreneur has. And I believe this, that because you are building something, you're building with your own sweat and blood, it's your idea. It's your effort. So whenever you are giving an equity, a part of that to anyone else, be it a VC, be it an investor, I'm really very shocked that yes, with this money, with this equity that I'm giving up, I am actually able to see and I'm able to create more value. So that is the advantage of debt over equity, that you are not losing any part of the of the value you're creating. However, from my own experience point of view, from speaking to other entrepreneurs, it's best to avoid debt unless you have a steady income every month. So if you look at this there are companies like Redcurrent Club, for example, which does revenue-based financing and has really come up in a big way helping D2C brands. But it's best to go to them only after you have, say, a 2 crore or 3 crore regular revenue every month, and then you take some time to get there, like I said. Equity, now I have raised equity, so we just raised, right now I'm the founding partner at My Operator and Neophone. My Operator was bootstrapped for 8 years before we raised funds. When I joined them last year, I came in as a co-founder, after I had exited my last startup, which was Sportal. So I said that, for the next, we have grown at this stage for the last 8 years. Now we're looking at an exponential rate of growth because we've come up with a product which is looking at a large TAM, before the TAM part of it, which is the 10 crore plus SMB, small and medium business in India. We've built an app-based system which can help the smallest micro business. Could be a salon, could be a tomato wala, for example, could be a daily store. Basically set up its customer experience online with calls and WhatsApp. So the TAM for that is huge. If you look at just India, it's 10 crore plus SMB. If you look at places like Africa, Latin, South Asia, which are all places with high emerging economies, the TAM is even huger. So when we're looking at this kind of a TAM and we want to go at a certain speed, we also want to make sure that there is a moat created, right? Because technology is copyable. Of course, there are technology like OpenAI or Google which have been kind of miles ahead. And it probably will take ages to copy them. But still you see the kind of competition, right, with Google and OpenAI right now. So any technology, once the idea is out in the market, is probably copyable. It's the execution that matters, and to execute it quickly, you need funds. And there's no kind of doubt in my mind the kind of importance that VCs or angels bring to the table. If they're taking an equity, because they're also adding value. Because that fund at that critical point is very, very important for an entrepreneur. I have a great idea, I probably can build a great product, I can probably take it to a large market, but I need the initial capital, especially as I said, it's an engineering driven product. It's a product that will be in gestation for a couple of years before you start seeing the profit. That is number one. Number two, I think I agree largely with all the investors and the angels in the room who talked about focusing on profitability, right? So, I myself have fallen into that trap because I think 3-4 years back, it was cool to not be profitable for years and just grow while burning. And we've seen companies falling in that trap, right? And they are probably good business models. Not really always blame the founder. It is just that the fact that was there, right? Even at that point, probably when VCs came and told them grow at any cost. But now, standing in 2024, there has been a sort of a course correction. Now we're talking about entrepreneurs who are very strong on fundamentals, very strong on unit economics. So you might not be profitable, operationally profitable from day one, but at least the unit economics should look good. If I'm earning 1,000 rupees and all I'm earning is only 10 rupees, obviously that unit economics doesn't look good. So unit economics is something that you focus on from day zero, which is what we have been focusing on even when we are building KO, that unit economics looks good. They're not profitable, far from being profitable because there's a lot of money being sunk to keep the engineering team, there's generative AI systems being built. So obviously, there's a lot of R&D costs involved. One, I think you have positive unit economics and you can show a great TAM, you can show great scale, you show a great founding team, then the ball is in your court as far as the negotiation of the equity is concerned. And I have been, this is something that I probably learned from my co-founders. I was probably more lackadaisical about it to start with because as I said, my initial philosophy was also grow at any cost. Then I realized that you don't give up equity so easily. You build traction, you show value, you show profitability, you show certain traction, you show certain, you basically validate the problem before you go to anyone for the money. And obviously at the end of the day, the best investors are your customers. Earlier I can go to that profitability path and I can sustain my business by the funds I'm generating. I am probably not giving up any more of my equity. That is probably the situation that most true entrepreneurs would want to get to. Of course, there's always the game of exit, etc. Not getting there. I'm not saying what is right, what is wrong. But as I said, if your fundamentals are strong, VCs will back you. They'll back you probably at the equity value that you're looking for, and you would not be playing a losing game of constantly start trying to elevate your valuation at whatever cost. So I think that is something that I have learned from being an entrepreneur for the last 8 years. Some lessons have come really hard. At one point, we even sold our house to repay some debts. But anyway, that's all part of being an entrepreneur, right? You take the risk, you have the gut. That's why the glory is yours. I want to end with that.
I think we have very little time. So probably we have
Yes, but I will wait for, if you have any questions, I'll take, if you have any one of you. Okay, so I have a question in terms of the appropriateness of funds. So a lot of these businesses, particularly at whatever stages, one is appropriateness in terms of timing. I made it in 3 months, and you are giving me in 4 tranches after over a period of 8 months. And I need maybe 20 lakhs, you are giving me again. You're tranched it, maybe giving me 4 lakh, 5 lakh, whatever. So how does that work? What are your views of that?
Firstly, any kind of a long-term partnership needs very good understanding of what you're getting into. So just the way investors do diligence on founders, I normally recommend that founders also do diligence on the investors they are speaking to, because there are all kinds of investors. And one of the best way to do a quick due diligence is to check who their portfolio companies are, pick up the phone, speak to those founders, ask them what their first-hand experience has been. The reason I bring that as a context to the question you're asking is a lot can go wrong in a tranched relationship, right? And it's actually whether the investor means what they say when they say they will put in the money in those tranches, because the founder will be building in anticipation of those tranches coming in. For whatever reason, if the investor backs out, whether for good, right, wrong reasons, you need to know what has been the propensity of behavior of that set of investors. So, and if an investor has proposed that tranche, maybe sitting across the table and understanding the thought process of even that process of why should it be tranched. Do they not have faith in the business growing in a certain manner? Do they not believe that this is capable of being built in a certain manner? Those are the kind of questions the founders need to ask, hard questions. It's okay if the money goes away. Don't just take money just because someone is offering it to you. So that the founders need to be smart about it. It's your company, it's your sweat and blood. So be careful what you're giving away.
Great, very good point. Because there is something which is very important for a lot of people to learn, particularly youngsters who get probably swayed by this, that they're getting a lot of fund from somewhere and maybe a little easy money, and they fall into the trap of actually giving away a significant part of their equity within just before even they started crawling. So that's very, it's a significant risk actually. And now I'll come to Yamika again. On this, let's say when you are looking at these businesses, we get to see, because if you see the kind of distribution that you have in this group, the kind of flip charts, we don't have the technology. Unfortunately, technology couldn't even make it to this room, so it's falling outside, which is unfortunate. So the guy couldn't even
That's
make it.
because technology grabs all the attention.
So it's outside. So by putting it to here, is that are you also kind of looking at, do you give a preference to people who are either technology driven or technology enabled? So what are your views on that in terms of when you are looking at new business?
So, of course, why technology gets all the attention is because it is able to bring a lot of profitability into businesses. You build once and then you are able to sell forever to gain profits from that business. That's why technology gets the advantage. But if you talk about in terms of, we as an organization, what kind of founders we prefer working with or like to work with, etc. We love working with business-driven founders who are non-technical people, who have done some kind of business or have very deep understanding of a particular sector, and want to build a technology-first business or a product-driven business because it is easier to scale a technology-driven business. For example, even if we take an example of manufacturing, say any B2C product, any cosmetic product, it's okay, it's a product, you manufacture it. but the way to distribute it faster and to a larger number of people goes through technology. So today every business has to have technology with it and has to think in a technology first manner to be widely available, to be widely successful, etc. In this room I saw somebody distributing eco-friendly packaging, products that are wrapped up in eco-friendly packaging. Now it's great that you, as an alternative to plastics, now it's great that you've been able to develop that, but for you to be able to put it in front of a maximum number of people and to make profits out of it, you need to think technology first. So as a venture builder, for us, we become that technology partner. All we need in founders is to have that understanding of business, market, their own product, and we give them that sense of what kind of technology should be brought in to be able to accelerate the growth of that product and business.
Thank you. So I think in the interest of time, we have quite a few other questions, but we'll probably wait for the break times when we have opportunity to be able to interact with each one of them. They're going to be here at least for this program through the day almost. So please feel free to interact with each one of them and please clarify if you have any points. I think we tried to touch upon some of the key points, but yes, there are many more that can be spoken about. So I take this opportunity to thank this panel. Thank you very much for your time and appreciate it. Thank you so much.